What if I told you that the value of the money in your wallet, what it can buy, what it can save, what it can grow is not determined by how hard you work, how smart you invest, or even how much the economy produces, but by a hidden network of individuals and institutions, often invisible to the public eye. A network so powerful that a single decision made in a windowless room in Washington, London, or Frankfurt can ripple across the globe, making fortunes disappear overnight, or turning ordinary savings into almost nothing. Who are they? How did they get this power? And why does history show time and time again that the system is prone to shock, failure, and panic, despite promises that it's perfectly safe? That's what we're going to uncover today. To understand the hidden network controlling the value of your money, we need to travel back more than a century. Money, in its simplest form, is just a claim on something of value, a gold coin, a piece of silver, or even just a note promising to pay a certain amount. But in the modern world, it's no longer gold that guarantees your money's worth its trust, and a tightly woven web of financial institutions and central banks. Key figures emerge in this story. People like J.P. Morgan, who built banking empires that could sway national economies, and central bankers like Hjalmar Schacht in Germany or Paul Volcker in the US, who literally decided what money could buy through interest rates and monetary policy. These are not just names in history books. They are the architects of a system that most of us never see, but that touches every purchase, every loan, and every investment. Tease a twist. But here's the twist. The same network that stabilizes economies also creates fragility. And when that fragility breaks, the fallout can be catastrophic. The story begins in the late 1800s. Gold standard tied national currencies to a fixed amount of gold, which sounds stable, but it created its own vulnerabilities. Nations that overextended themselves economically could face devastating crises. This vulnerability paved the way for powerful bankers to step in, offering loans and financial advice that would essentially give them influence over entire economies. By the early 20th century, this network of banks, and emerging central banks became the invisible hand, controlling not just individual wealth, but national prosperity. Decisions made in a single boardroom, whether to tighten lending, adjust interest rates, or manipulate currency supply, could ripple across continents, and in many cases, ordinary citizens had no idea who was making these decisions, or why. The rise of this hidden network accelerated after World War I. Economies were unstable. Debts were high, and governments leaned heavily on central banks and private finance. The 1920s showed the world the power and the danger of this network. Speculative bubbles, driven in part by easy credit and market manipulation, grew unchecked. Then came 1929. The stock market crash wasn't just about overvalued shares, it was about leverage, debt, and decisions made by a select few who understood the system's levers far better than the public. When the network faltered, ordinary people felt it in their savings, their jobs, and their very survival. Yet, each crisis didn't destroy the system, it strengthened it. Central banks became more coordinated, new regulations were created, and the network became more sophisticated. By mid-century, it was a global web, touching every major currency and financial hub. But power comes with risk. The network that decides the value of money is not infallible. History is full of breaking points. In the 1970s, the collapse of the Bretton Woods system, when currencies were untethered from gold, led to runaway inflation in some countries and devastating recessions in others. In 2008, the shadow network of banks, derivatives, and credit default swaps nearly brought the global financial system to its knees. A few risky bets by a few institutions, combined with insufficient oversight, wiped out trillions of dollars of wealth. And yet the people making the decisions largely escaped unscathed. Each breakdown follows a similar pattern. Concentration of power, complex instruments no one fully understands, and a fragile trust that holds it all together. The fallout from these crises is often felt for decades. Bailouts, austerity measures, and emergency policies patch the system temporarily but rarely fix the underlying fragility. Citizens lose jobs, retirements shrink, and inequality rises, while the network remains largely intact. Governments and international organizations have tried reforms. Stricter banking regulations, transparency initiatives, and even digital currencies. Yet patterns repeat. The network adapts, finds new ways to consolidate control, and the cycle begins again. History shows that the system's failures are rarely random, they're structural. Today, this hidden network is more powerful and more opaque than ever. Central banks control interest rates with a precision unimaginable a century ago. International agreements on currency swaps and monetary policy occur behind closed doors. Algorithmic trading moves billions in milliseconds. Consider this. The global money supply today is over $100 trillion. Yet, a few decisions by a small group of central banks or financial institutions can create inflation spikes, crashes, or asset bubbles that wipe out wealth almost overnight. History repeats itself, only faster and more intensely. And the people most affected are often those with the least access to the decision-making rooms. Shocking data examples. In 2023, inflation rates surged globally, in part due to central bank policies responding to crises created in other parts of the network. Cryptocurrency markets, often touted as decentralized, still react to policy announcements from traditional financial institutions, proving the network's invisible reach extends even into new forms of money. So what can we learn from this hidden network that decides what your money is worth? 3 crucial takeaways. First, money's value is not absolute, it's relational. It exists because of trust, networks, and shared belief, not intrinsic worth. Second, power is concentrated. A few institutions and individuals can influence global economies far more than the average citizen or even government policies. Third, history repeats. Crises aren't anomalies, they're predictable patterns arising from systemic vulnerabilities. Understanding this pattern can help us navigate risk and protect our wealth. The hidden network that decides the value of money is both a stabilizer and a threat. It can create prosperity or chaos, and the more we ignore it, the more vulnerable we become. The question is not just whether the system will fail again, but how prepared you will be when it does. Money, power, and trust are intertwined. Knowing who pulls the strings and how may be the first step toward real financial awareness. If this deep dive into the hidden network of money intrigued you, hit that subscribe button and turn on notifications. We uncover the stories behind the systems you thought you understood, because the more you know, the less likely you are to be caught off guard. And if you want, check out our next video where we explore the rise of digital currencies and how they challenge the old network in ways history may not have prepared us for.